obviously the gold and silver strategy is the best. I mean, on physical gold is up like 65% this year.
Mm-hmm.
Physical silver is up about 120%.
Yeah.
The mining stocks have more than doubled, right? Some have tripled and quadrupled. They're still cheap. But even my strategies that are not even, gold and silver, my basic dividend payers strategy, where I invest in dividend paying foreign stocks, is up about 60% on the year,
Wow.
which is 4 times, I think, the S&P 500.
Mm-hmm.
So, because some people think, Peter Schiff, he's bearish, he's a perma bear, and he's just missing out on gains.
I think you say that actually, I was reading your book, Crash Proof 2.0, and you were saying that kind of moniker is not right, like the perma bear moniker.
Well, I mean, I've been negative on the U.S. for a long time, and I've been accurate despite all the rate cuts. We've had 2 rounds of now like 75 basis point rate cuts, yet the yield on the 10-year is still north of 4%, almost 4.2. I think it's going a lot higher, but the fact that it hasn't gone lower is a warning sign. But gold and silver are screaming that a currency crisis is coming. I think the foreign central banks have been out in front of this now for a year or two. They have been replacing dollars with gold. They've been, moving towards having real assets as reserve. Now, the gold reserves are now larger than U.S. Treasury reserves. A lot of that is not the result of the buying. I mean, some of it is from the buying, but most of it is from the appreciation in the value of their gold reserves. But that's going to continue, and I think they're going to step up the amount of buying. And I think other central banks that weren't buying gold, they're going to start buying gold. And I also think private investors that haven't been active are going to get active. In fact, Morgan Stanley, I guess their analyst came out a couple months ago and tweaked the 60-40 portfolio and said we should do 60-20-20 and, cutting the bond allocation in half in favor of gold. And that's basically a sell signal on bonds. And it's Morgan Stanley maybe coming to the realization that they're not really a safe haven, that the yields aren't high enough to offset what you lose to inflation. And so people need to hold gold. And that's going to be very problematic because we have, out of control deficit spending. And if foreign central banks aren't buying our debt and American investors aren't buying our debt, who's going to buy it? That really leaves the Fed as the last man standing. And in fact, one of the predictions that I've made for a while.
For years, foreign central banks have been quietly reshaping their reserves. Instead of accumulating U.S. Treasuries, they've been increasing gold holdings at a historic pace. In fact, gold now rivals or exceeds Treasuries as a reserve asset for many nations. While part of this shift reflects gold's rising price, the strategy is deliberate: diversify away from dollar risk. What's more important is momentum. Countries that once avoided gold are now reconsidering, and private investors are beginning to follow. This is not speculation. It's a defensive response to debt expansion, currency debasement, and growing doubts about the long-term stability of fiat systems.
Was that the Fed would return to quantitative easing again, and they basically just effectively did that at the last FOMC meeting, announcing this $40 billion ongoing purchase of Treasury securities. Yes, they're short-term, but so what? Still QE. I don't care what they want to call it. They're monetizing debt. They're expanding the money supply. They're buying U.S. government debt. That's QE. And I'm sure it won't be long before they expand the program and extend the duration. And I think that, we're headed for this dollar crisis, this currency crisis. The result is going to be an explosion in consumer prices and ultimately long-term interest rates. And it's going to be, a huge problem for the U.S. economy. Mm-hmm. And politically, I think it's going to be a disaster for the Republicans. I think it's going to mean that we're going to have a very radically left Democrat in the White House in 2028.
Wow.
With probably a radical Congress that might actually help them get that socialist agenda, passed. So so unfortunately, I don't, I see a lot of problems coming in the near term. Obviously, the gold and silver strategy is the best. I mean, on physical gold is up like 65% this year.
Mm-hmm.
Physical silver is up about 120%.
Yeah.
The mining stocks have more than doubled, right? Some have tripled and quadrupled. They're still cheap. But even my strategies that are not even, gold and silver, my basic dividend payers strategy, where I invest in dividend paying foreign stocks, is up about 60% on the year,
Wow.
which is 4 times, I think, the S&P 500.
Mm-hmm.
So because some people think, oh, Peter Schiff, he's bearish, he's a perma bear, and he's just missing out on
But
gains.
I think you say that actually, I was reading your book, Crash Proof 2.0, and you were saying that kind of moniker is not right, like the perma bear moniker.
Well, I mean, I've been negative on the U.S. for a long time, and I've been accurate.
The traditional 60-40 portfolio is quietly being dismantled. Major institutions are questioning whether bonds still protect capital in an inflationary world. When yields fail to outpace rising prices, bonds no longer preserve purchasing power, they destroy it. Cutting bond exposure in favor of real assets like gold is effectively a vote of no confidence in sovereign debt. This creates a dangerous imbalance. Massive government deficits require constant buyers, yet both foreign and domestic investors are stepping back. That leaves central banks as the buyer of last resort. When governments rely on money creation to fund themselves, the line between monetary policy and monetization disappears.
Right. And, we're in much worse shape now than we were 20 years ago. We have much more debt than we had back then. The problems are much bigger. But the stock market has gone up.
Mm-hmm.
See, a lot of people want to say, oh, well, Peter was wrong to be bearish because the stock market has gone up. But I'm not bearish on the stock market.
Like you said, you're not shorting the stock market.
Well, no. I mean, there have been time periods where I thought the market could correct.
Mm-hmm.
And I think we're in one of those time periods now.
Mm-hmm.
I'm still not short.
Yeah.
But I think that we could get a correction. But I think the Fed will, step up. I think, that the monetary policy is designed to truncate any kind of market decline and to, move it back up again.
Yeah.
Even though that is destructive economically, they don't care about that. They just want to keep air in the bubble. Now, eventually, they won't be able to do it. There's too many holes and the stuff is going to deflate. But the crash that I see coming and that I've seen coming for years is not a crash in the stock market. It's a crash in the dollar. Now, we haven't had the crash in the dollar yet, certainly not against other fiat currencies. We've had a big decline. I don't know if I'd call it a crash, but it's a major decline in terms of gold and silver, right? We've seen a big drop in how many ounces of gold you can buy for the dollar. And of course, the cost of living has gone up. So in terms of domestic purchasing power, we've seen a major decline.
Mm-hmm.
But we haven't seen the type of foreign exchange decline that I've been anticipating and that I still anticipate.
Yeah.
And that's also one of the reasons behind my strategy. Look, I have very little cash, and I've had very little cash for years. We're pretty much almost fully invested at all times because I don't see the value in cash. There are people that'll say, oh, I'm worried, so I'm going to hold a lot of U.S. Treasuries. Well, why? I'm worried about U.S. Treasuries. I don't want to hold those. I'm worried about not only the government's ability to repay them in real money, but inflation is going to destroy the value. Interest rates could rise. I mean, I want safety from Treasuries.
Whenever markets wobble, central banks step in, not to fix the economy, but to stabilize asset prices. Liquidity injections, balance sheet expansions, and bond purchases are justified with new labels, but the function remains the same, creating money to absorb government debt. This strategy delays pain but amplifies long-term damage. Inflation becomes embedded, productivity weakens, and distortions grow. Eventually, markets stop believing the narrative. The real crash isn't stocks, it's currency confidence. When faith in money breaks, prices surge, yields spike, and policymakers lose control. History shows that once this cycle accelerates, reversing it becomes nearly impossible without severe economic consequences.
I don't want to take refuge in Treasuries. So that's the last place I'm going to be, even in the short end of the curve. I want to get out of the dollar. So I have these dividend-paying foreign stocks, and they've produced great returns. This is the first year in many years where they've significantly outperformed the U.S. stock market because the U.S. stock market has been overvalued. And I think that's going to continue. I think that even if the U.S. stock market doesn't crash, I don't see that it's going to put up impressive returns on the upside, even nominally. And I think that you're going to see a significant underperformance between the U.S. market and foreign markets and between emerging markets. And so we're fully invested in dividend-paying foreign stocks, emerging markets, resource stocks, not just precious metals mining, but some industrial metals, energy, agriculture. I mean, I'm basically got the inflation trade, and that's what I've been in for decades now, because that's what drives our whole economy. It's inflation. They just keep printing money, expanding credit, and this is distorting the economy. But it is ultimately going to reward people who anticipate it, who understand it, and invest the right way. And this has been like a real outstanding year for gains for that strategy. And I think it's the beginning of a long period of time where this is going to be the case. And, a lot of investors have been investing in the U.S. stock market because it has been the best performing market. And this year changed that. And now I think a lot of the money that went into U.S. stocks in the prior decade is going to come out of U.S. stocks. A lot of people are going to be looking to invest overseas. I mean, first, it's the people that are already overseas that are just taking their money back. Right? So Europeans, Asians, South America, they're going to take their money home and invest it. But then you're going to start to see Americans looking abroad and seeing that the returns are so much better outside the U.S. than inside, and that they're going to want to do that too. And that's going to be very problematic for the U.S.
For over a decade, global capital poured into U.S. assets, lifting stocks and suppressing yields. That trend is now shifting. Foreign investors are repatriating funds, while Americans are increasingly looking overseas for value, income, and stability. Emerging markets, commodities, and dividend-paying foreign stocks are outperforming, not because they're perfect, but because U.S. assets are priced for a world that no longer exists. As capital exits, the U.S. loses a critical advantage: external financing. Fewer foreign buyers mean higher borrowing costs and weaker asset support. This transition doesn't happen overnight, but once it gains traction, it reshapes markets for years.
Well, the gold and the dollar compete. And gold is really, again, like the canary in the monetary coal mine. And when you're seeing a big increase in the price of gold, it is indicating a loss of confidence in the dollar. That's why people are buying gold. And they're foregoing the interest that they could otherwise earn on U.S. Treasuries. So no, I don't want to earn 4% on a Treasury. I'll hold gold and I'll earn nothing. And that says a lot, right? Because you don't believe that 4% is worth it, that it's not going to reward you enough to offset what you're risking by holding dollars or holding Treasuries. And as the price of gold goes higher and higher, that results in even more confidence being lost in the dollar. And it becomes a self-perpetuating spiral where more dollar holders want to convert them into gold, right? So that they can, stop the bleeding, what they're losing by holding dollars. And that's going to push up U.S. interest rates, because the only way that the U.S. can compete then with gold is by offering a higher rate of interest. Okay, 4% is not enough. What about 6%? How about 10%? But the problem is we can barely afford 4, let alone 6, 8, or 10%. So we can't really pay our creditors a high enough interest to keep them lending because we can't afford it. The only rates that we can afford are rates that are so low that nobody wants to lend us the money. So the only lender becomes the Fed, because the Fed doesn't care about the return, and it just prints the money into existence and lends us that. But then, now you have runaway inflation or hyperinflation. So I think we're very close to the collapse of this system. And remember, the whole U.S. economy has been built on the dollar being the reserve currency. That's how we function. Trump doesn't understand this. He thinks the world is screwing us over, but it's actually the other way around. We've been screwing the world over, getting all their stuff for free.
Gold's rise is not about greed, it's about protection. When investors choose gold over interest-bearing debt, they're signaling distrust in the currency itself. As confidence falls, the system faces an impossible choice: raise rates to defend the dollar or print money to fund government spending. Either path leads to instability. The likely outcome is prolonged stagnation paired with high inflation, an inflationary depression. Living standards fall as essentials become more expensive and asset values weaken in real terms. Preparation is no longer optional. Diversifying away from dollar dependence, holding real assets, and owning productive companies may determine who survives and who is blindsided when the system finally resets.
But they produce all the stuff that we consume, most of it, and then they lend us the money to buy it. And, they invest the profits in our bond market and our stock market. So they keep consumer prices down, asset prices up. We think we're rich. We can borrow against those asset prices. And then we get all this stuff. We didn't need factories. We didn't need pollution. We didn't need the workers. We didn't need the raw materials. We just created the money out of thin air. And we got all this stuff from the rest of the world. And when we get this dollar crisis, that all stops. Right? The ride on the global gravy train is over. We can't import all this stuff anymore unless we export. And we don't have the capacity to export enough to cover our imports. So a lot of products that we used to be able to have won't be affordable to most Americans anymore. And if foreigners aren't selling us goods and they don't earn dollars, they don't need to buy our bonds. They don't need to buy our stocks. And so the price of goods goes up because we don't have as many goods, but the price of stocks really go down in bonds because we don't have all the foreign buyers. So, it's the worst situation where the value of what you own goes way down, but the cost of everything you need to buy goes way up. So, you see a significant reduction in the quality of living, the standard of living of the vast majority of Americans, which is, why they need to take action now to protect themselves. Because you don't know. I don't know when this dollar crisis is going to hit. It could hit any night, when I'm asleep. And I've always thought that it will happen at night because that's when the Asians are up and trading. And they're our biggest creditors. And that's probably where our fate's going to be determined. And I think a real dollar collapse will probably start in Asian trading hours. And so, look, you don't want to go to sleep knowing that you may wake up broke. So the way around it is just to have a portfolio of non-dollar assets, own good quality companies that you could buy at a low PE with a good dividend yield, own precious metals, own these mining stocks, have a portfolio that will not only survive, but thrive in an environment where you have a dollar crash and, U.S. economy is in a massive recession with high inflation. I've called it a inflationary depression, which is really what we're going to be entering into. It's going to be an elongated period of time with an extreme weak economy that maybe moves in and out of recession, but never really grows, but all the while has very high inflation. Think about the 1970s, only way worse. That's where we're headed. The only wild card is maybe AI, but we'll see where that, what can happen there with the productivity increases. But so far, I think it's more of a bubble than a game changer for now, although the potential is there for the game to change later. But I don't think it's going to change in time to avert this crisis.